What's going on, everyone? Welcome back. And in today's video, we're going to dive into one of the most important concepts in trading, liquidity. Specifically, we'll cover buy-side and sell-side liquidity, focusing on how they form around old highs, old lows, and equal highs and equal lows. But before we can fully understand liquidity, we need to break down something fundamental: swing points within the market. Now, swing points are crucial because they tell us where liquidity is likely resting. Let's start with a swing low. A swing low is created when the market forms a low with a higher low to the left and a higher low to the right. This shows us that price pushed down, reached its lowest point, and then reversed upwards. Now on the flip side, we have a swing high. This occurs when price creates a high with a lower high on both the left and the right. In other words, the market pushes up, peaks, and then begins to move lower. Now, why does this matter? Because understanding swing points helps us identify where traders are placing their stop losses. For example, if traders are looking to buy around a swing low, most of them will protect their position by placing their stop loss just below that low. Likewise, if a trader are selling at a swing high, they'll usually place their stop loss just above that high. This creates a pool of liquidity. Below a swing low, we have sell-side liquidity because sell stops and stop losses from long positions are stacked there. Above a swing high, we have buy-side liquidity, where buy stops and stop losses from short positions are accumulated. So when we talk about liquidity, we're really talking about these pools of orders resting at the obvious highs and lows. And that's why the market often gravitates toward these areas to seek out and trigger that liquidity. Now that you understand the basics, let's move over to the charts and break this down with some real examples. Now we're here on the daily time frame, and we'll be looking at the obvious highs and marking up the obvious highs and the obvious lows. So when we come into the market, we need to look for the most exact obvious highs and the most exact obvious lows. So we have here an obvious high as price pushed up and price pushed down. So price pushed up, making this the highest point before price then pushed down. You can see we have a lower high here, a high, and then a lower high here, making this the highest point price reached before it dropped. Making this a high, and when we see a high or a swing high, we mark it as buy-side liquidity, and then again we have a next high because price pushed up before reversing down. As you see, we'll name this as buy-side liquidity again, and then price pushed down and then pushed up before then reversing down, naming this as buy-side liquidity again. Now let's see what price does. Okay, now we have a sell-side liquidity because price pushed down and then it reversed up, so making this our swing low. So we have sell-side liquidity, and now again we have a next sell-side liquidity. This price pushed up, pushed down, and then pushed back up, making this a next sell-side liquidity. As you see, price wicked into our buy-side liquidity, sweeping liquidity, making a new swing low, making this as sell-side liquidity. And price swept liquidity, making a new swing high, making it as buy-side liquidity. In the process, making a new swing low, making this as sell-side liquidity. Price then swept both liquidities, making a swing high, making this as buy-side liquidity. Okay, so next thing we're going to take a look at is relative highs and relative lows and old highs and old lows. What it means is that price, or the two swing highs or the two swing lows, are very, very close to each other. For example, if you were to take a look at this swing low and this swing low, you can see that price, like you can see that they are relatively close, like they are very, very close. They come hand in hand. Now, if you were to look at this swing high and this swing high, you could see that they're also close to each other, making them hand in hand. And what an old high and old low means is that they are a previous low or a previous high. Now that we're done explaining the relative highs and what the relative lows and highs are, and the old highs and lows are, we can go ahead and look at the more important levels of liquidity that I personally focus on and I personally mark out within the charts. So to start it off with, we'll first go ahead and look at the weekly time frame to get our draws on liquidity and to mark up the charts to see where the weekly levels of liquidity are. So we have this weekly sell-side liquidity, we have this weekly buy-side liquidity, and we also have this weekly buy-side liquidity. Okay, now that we've done marked out the weekly chart, we can go ahead and scroll into the daily chart, then find our levels of liquidity. We have this daily buy side. We also have this. We also have this daily buy side. Again, we also have this, and we also have this. We have one here again, Now let's look at our sell-side liquidities on the daily chart. We have this daily sell side. We have this daily sell side, also have this. Now that we're done marking out the daily time frame, we can go ahead and look at the last most important liquidity levels that I focus on, and that would be the 4-hour time frame. 4-hour levels of liquidity. We have this for our buy side, we have this for our sell side, and we have a lot more for our sell side, but we're not going to mark them all out. Now let's go ahead and look how price would react to these levels, and we'll see exactly how they react. Okay, you can see that price came to this level. It had a major wick above and then closed below, sweeping all liquidity above this and then sweeping to this low. Then sweep the liquidity from here and liquidity from here to then go back up, making a new swing low and a new swing. Hey, and as you see, price took liquidity from both these. And after a little of consolidation, it went down below. You have a next sell side for our liquidity. And you can see price came in, swept this liquidity, and then went to this level of liquidity to then sweep it too. You also help a next 4-hour buy-side liquidity. You see price swept liquidity, and it went back down, and then it came and swept liquidity from the swing low. Price normally goes, and it looks for internal liquidity. It will go from sweeps this liquidity, and then it look for next liquidity sweep out. Price swept this high goes to this high. If price swept this high, it will look for next liquidity go to. Price either goes from external liquidity to internal liquidity. Price is always chasing liquidity. All right, traders, that's going to wrap up today's lesson on liquidity and how the market hunt stops around swing highs and lows. I hope this gives you more clarity on why price moved the way it does and how you can use that knowledge to your advantage. If you found value in this video, make sure to hit that like button, subscribe, and turn on the notification bell so you will never miss a next upload. Here at the Trading District, we break down the market step by step to make you a smarter, more confident trader. Drop a comment below if you ever had your stop loss hunted right before price went your way. I also want to hear your experiences. Thanks for watching, and I'll see you in the next one.